Welcome to another segment of the New Hampshire Dental Society Webinar Series, where it is my honor to interview and work with various groups and components to share valuable resources with its members. I am Joy Sorensen, a business partner of the New Hampshire Dental Society and the principal of my firm Advisory Resource Group, where I've been assisting the needs of dentists and medical professionals as both a financial advisor and a practice consultant for over 15 years. Good evening. Thanks for joining another session of the New Hampshire Dental Society Webinar Series. For those that don't know me, my name is Joy Sorensen. I'm a business partner with the Dental Society and make it a point to do a number of these educational videos, all of which are listed on my website, advisoryresourcegroup.com, in the Media Hub, which is under Dental Education. So tonight, I'm extremely excited. We have a student loan consultant, Joy Sorensen Navarre, who is a national student loan consultant. I met Joy originally when she was working with Tufts. Joy does a lot of her work working with the larger institutions and then sort of feeding back down to the individuals. So she is definitely an expert on the topic, and I'm excited to have her. And so the hope tonight is we'll let Joy speak for maybe 30 minutes or so, and then we can have a question and answer session if we'd like. If anyone would like to ask questions during the event, feel free to raise your hand. You can do that on your control panel, and or we'll just wait till the end and do it that way. But Joy, without further ado, if you maybe want to give sort of a quick introduction and then get into it and go from there.
Thanks, Troy. It's great to be with you tonight and with the New Hampshire Dental Society. I'd like you all to think and imagine with me for a minute a time when you, in a professional role, had a patient or colleague that asked you a question that you thought you should know the answer to, but you really had nothing to give them. Can you think of that kind of an example? So a time when someone asked you an important question, but you didn't have an answer for it. All right, you don't have to disclose what it was.
Every day.
Yeah, every day, exactly. Well, let me show you a picture of the person that this happened to me with. This is Dr. Carl. Dr. Carl is a very special person. He's active in his medical society. He's someone that's a go-to person for questions, very astute, not just in his own field of study, but in things like student loans and other odd things like mountain climbing, for example. And he's such an inspiring person that he actually inspires his colleagues to climb mountains with him. So there you go. You know what kind of a person he is.
Absolutely.
Well, many years ago, I was a financial advisor, perhaps similar to Troy and his agency. And I was working with a lot of highly educated physicians, pharmacists, dentists that were working on building their future wealth and other questions related to their financial well-being. And I was not very smart at all about student loans. And in fact, I thought if my clients had student loans, they were very intelligent people. They would figure out for themselves how to manage them. And so one day, Dr. Carl came to me and he said, Joy, I am really worried about my student loans. They're as big as a house, and I'm afraid if I don't figure out what to do, they're going to sink me. And I commiserated with him, and then he asked this question that was problematic for me, because he said, Joy, I found some programs that I think are going to be good for me. These were the income-driven repayment plan programs. And he said, I'd really like your professional opinion on them. My heartbeat started beating really fast. My stomach was in a knot. Maybe you can, understand how I was feeling too, because I had nothing. I had nothing to share with him because I didn't know anything. I was tempted to lie and make something up, but truthfully, I couldn't think fast enough to come up with anything. And of course, I'm glad I didn't. And so I said to him, Carl, I'm sorry, I don't know, but let me look into it and I'll get back to you. So I tried to find someone that I could refer Dr. Carl to, who was smart about student loans. And back at that time, I couldn't find anybody that I trusted. And so got smart about it and after a lot of research and a lot of work, was able to answer his specific questions, and we ended up saving him a boatload of money on his student loans, which he was really happy about. Why I tell that story today is because I'm excited, Troy, about what we're going to be talking about today with the Dental Society members and new members, because when folks understand broadly what their options are about student loan repayment options, they're able to make great decisions that can put them in a much better place in the future. So here's what we're going to talk about. We're going to cover the income-driven repayment plans. We're going to talk about options for private refinance. And finally, we're going to talk about flipping the script on student debt. So let's go. So here's the background. Almost everybody that has an advanced degree has student debt. And so, Troy, would you mind sharing with me, what size of debt have you seen to be common for folks that have finished their dental education?
Yeah, I'd say it's not uncommon at all. $200,000, $300,000, $400,000 is pretty common numbers these days.
Mm-hmm. That's exactly the same in our experience. We consult over the phone and computer every day with doctors, and we see the most common numbers we see very similar. $250,000 to $450,000 are the most common numbers we see. We see a lot more than that too. We see 500, 600. The most we've ever seen was 798. Just between you and me, that was a surgeon who was ignoring his student loans, and I gave him some tough but good advice, and I think he's not going to take it. So most of the time we can help folks, but there are those outliers. But anyway, let's go to the next slide. So here's what we know about what's happening to doctors that have student debt. The next slide talks about the research that Dr. Julie Phillips does out of the University of Michigan. And actually, before we do that, let's talk about what it looks like for folks when they have this size of student loan debt. I think for a lot of folks who aren't in the medical or dental professions, they don't realize the pressure that folks are feeling. So, and there might be people on the call that had student loans for medical education, back 10, 15 years ago, and they're on the call because they're concerned about bringing early career doctors into their practice. And so it's important that everyone understands what the current reality is today. So today, if a doctor has $300,000 of education debt, their monthly payments are $3,500. Now, sometimes they get advice from folks that might be further along in their career that went to school earlier, back when interest rates were low, when money was almost free. Do you remember, Troy, what interest rates were way back then?
I sure do, yeah. 2s and 3s. I still have have interest rates in those levels from way back when. The good old days.
And so are they in a hurry to pay off that education debt?
No.
Not at all, because it was almost free money. And what kind of interest rates are we seeing today?
Yeah, what are we seeing? So, and I forgot to mention as well, I'm sorry, Nate's on the call as well. This is Ava Linder's husband, correct, who's sitting in for Ava this evening. So sorry, Nate, I didn't mean to forget about you.
Oh, it's fine. It's fine. My interest rates, I believe, are like 7.4% for one, and then another private loan's 5.6, something like that.
Thank you. That's exactly right. That's what we're hearing. 5 to 7 to 8, even 10% on some private loans. Exactly. And so the old strategy to pick an extended repayment plan and pay your student loans off 25 or 30 years from now is no longer the best advice, because if you have a 7% interest rate on your student loans and you pay it off on the extended plan, in this case, you're going to pay $344,000 of interest on your $300 of principal, so you're going to end up paying for your student loans twice over. So it's important that we know these numbers together, even if there are folks on the line that don't have student loans themselves or have that student loan from years before. This is important to know. So let's go to the next one, which should be There we go, the research on borrowers. So Dr. Julie Phillips researches physicians in family medicine. So this isn't specific to folks in dental practices. However, I'm thinking that perhaps there are maybe similarities. So she's seeing that folks who have student loans are showing symptoms of depression. They're putting off their major life decisions. And in some cases, they're regretting having chosen their career in family medicine. Now, Troy or Nate, in your experience, what are you hearing from other folks in the dental field about student loans? What are people telling you? Is it having an impact? What are you seeing? What are you hearing?
It's kind of a mixed bag. So my wife and I are both doing the repay, where it's the minimum payments possible, and we were actually advised the strategy of doing that for a couple of years, basically so that we could get on our 2 feet and get a house, get stabilized somewhere, start saving up some money, and then switch over to a graduated payment plan later. But the repay plan still sounds like a pretty good option if it actually does what it says it's going to do, and we just pay off the tax at the very end. So it's tempting to just do the minimum payments and actually live your life, and then there's another half of the group that's paying $5,000 a month and eating ramen noodles every night.
Well, and I think
kind of decision you're making.
Yeah, and I think what I would echo is the same thing, is that I see people, certainly when I first meet them, that are doing lots of different things and have lots of different emotion over their debt. Some don't think about it at all and kind of put their head in the sand, and others, it's something they're literally thinking about every day and having anxiety over.
So true, so true. I'm ready to jump into your numbers, Nate, to look and see what the outcomes will be for you. So let me just say to the group that's gathered here listening, so the strategy that Nate and Ava are taking can be a fabulous strategy, right? And obviously the student loan repayment decision has to be taken in consideration with everything else that's happening within a family's life, right, or a practice's life. And that's why folks often consult with me on the student loan piece, or someone like us, and then take that information and bring them to their trusted advisor, Troy, for example, in this case, to say, this piece, how does this piece fit in with the rest of my overall financial plan? We're skipping ahead a little bit, but let me just say here, I am a very strong believer in making sure you have solid data from which to make a decision on the student loans, for example. And so that's why I said earlier, Nate, I would love to be like crunching your numbers right this minute to see what your options would look like on the revised pay-as-you-earn compared to the pay-as-you-earn. So I'm going to write that down as a question, and if I forget, Troy, would you remind me at the end?
Well,
absolutely.
With that? Okay.
I'm sure Nate
also, we really have a choice when we applied for it too, and I guess there is a choice, but the option that you have when you apply for that, it says, give me the one with the lowest payment possible. And if you select that, they put you into that group. So that's the one that we both got put into. So
Gotcha. Right, and that can be a great option. And sometimes there are some other options that might be better in the long term, right? So that's why we like to crunch those numbers.
Yeah, and I think what you just said a moment ago, Joy, is near and dear to me, which is to understand the variables. I think part of what sort of comes to me in my practice is that these aren't small numbers that we're dealing with any longer. Maybe they never were relative, but certainly not now. And so if we're making these significant decisions with significant amounts of money, we really kind of want to know why we're making it, and to your point, that it's fitting into the overall context of what it is we're trying to accomplish. And that's always my concern, is that it's really easy to make a mistake, right? There's a lot of options, and it's a lot of money, and that's what we're really trying to avoid.
I'm totally with you on that, totally. All right, good. The last thing I wanted to say, back to Dr. Julie Phillips's research, is that she's showing that the stress of student loans is actually having a negative impact on physicians' performance of healthcare. So now this is a big issue for me as a healthcare consumer, right? Because the fact that the folks that are taking care of me and the people that I love are feeling stressed about their student loans and how that might impact the kind of care we're getting. Now that is a systems issue, right? And it's based on a student loan system that is, in my opinion, broken as well. So that makes me think that this is an issue for all of us to be working on. And so I'm glad, Troy, thank you so much for bringing us in to talk about this, because these are the kind of things that often people don't know where to go, or they go to the websites to try and figure things out, and they have a hard time understanding how it directly impacts their situation. So getting good advice can bring peace of mind. And for me, I think it helps in a small way, perhaps, in our healthcare delivery system. So there you go. I'm changing the world. Here we go.
Doing our part.
All right. Yeah, I'm doing my part. Thank you. Thank you. So are you. All right. So I think our next slides are talking about what our options are. Oh, hang on. Let me just stop and talk about flipping the script on student debt. So I am a strong believer in doing things differently around student loan education and advice. And so the turtle reminds me to talk about this. So let me just check. So either Troy or Nate, when you're talking to other folks in your field, or I don't know, Nate, or if you're in the world of hiring other dental professionals to join you, what is the conversation about student loans related to colleagues or hiring new colleagues? Does it come up? What? Mm-hmm.
Well, so Ava and I are new dentists. We just started this year. We're not we don't have the privilege to be hiring anybody at this point that's new. We're still in that period where we are the new ones. So our conversation basically goes to trying to explain to folks how much debt we're in, and I don't think people really understand it. My favorite comments, in the dental chair, I just do a crown on someone and they'll say, well, I just paid for your for your new boat or something.
Oh, brother.
Like, well, no, that's not actually how it works. But just $500,000 in debt just so I can sit here with you today.
Right.
Right. Exactly. And we're finding, I work a lot, as Troy said at the beginning, with institutions, organizations, that hire medical professionals. And the recruiters and the top leadership tell me that they are not having the discussion about student debt with their candidates because they don't have anything to offer other than, maybe like a $20,000 signing bonus or, whatever it might be, but it's really nothing compared to, right, the size of their debt. And so the recruiters and leaders, aren't having the conversation because they don't want to be poking at a sore tooth, right? And so I think it's time for us all to start talking about it, because there are some great resources and there are some great things to consider when you're thinking about your student loan options. And so at the next slide, it just reminds me of a story I want to tell. So we offer education, we offer tailored student loan advice, and it's always interesting to me how I never know at the beginning of a conversation with a new client what the outcome is going to be. So just last week, I had a conversation with two dentists, and they were similar perhaps to you and Ava, as they were both relatively new in their position. And they had both taken jobs in a very rural, federally qualified health center in a Western state, just say it that way. And they had taken these two positions because they had student loans. They were hoping to get some of the National Health Service Corps dollars to pay off their student loans. Unfortunately, neither one of them got the money the first year. Neither one of them was awarded the money the first year. They were in their second year. They were hoping that they would be selected to receive the dollars in the second year. And so we were working with them on, we're pursuing the National Health Service Corps money and thinking about, potentially moving back to the state where one of the doctors had a father who had a practice of dentistry. They wanted to get their loans paid off in this rural area and then move back to this beautiful urban setting, also in the West, to work, for their father's practice. And so we started crunching numbers similarly to you guys probably, is the revised pay-as-you-earn best? Is the pay-as-you-earn the IBR? And I was pretty certain, just sort of in my gut, that it was really going to be beneficial for them to, spend time where they were, continuing doing what they were doing. And actually, as we continued the conversation, it just became so clear to me that one of the spouses in the situation was just not happy in the lifestyle in the very rural area where they were. And this person was just desperate to get back to the lovely urban area to start practicing in this private practice. And when we ran the numbers about, pursuing the National Health Service Corps dollars or, getting the higher salary in the urban setting, in the private practice, the difference related to earnings and student loan payment was going to actually make it better for them to pay more on their student loans, but earn more in this private practice setting. And so for them to come to that realization by running the numbers and actually seeing what was possible, plus that's where one of the spouses' heart really was to get back there, made such a difference for them. And I frankly was very surprised that the numbers turned out the way they did. So that's just a story to tell you that, we really never know what the best option is until we, dig into it to find out what it's going to be.
Sure, and I would echo. Sorry, I was just going to say, and I would echo what you said earlier, Joy, about working from details and numbers and really crunching those numbers to determine that, because sometimes it's not always what it seems. Sorry, Nate, go ahead.
No, yeah, I was just going to say that when we moved out to New Hampshire to start working, I turned down a pretty big scholarship from the Finance Authority of Maine to work in a rural area, a rural setting at an FQHC. And, when we were looking closely at it, well, one, it was going to make a major impact on our family life, where we were going to settle down, start a family, have a house, and do the whole 9 yards. But then also looking at how much more money that we would make just by going into a private practice that we knew was going to be successful. And it made sense to turn down the scholarship and pay that off as a loan, the private loan that I talked about earlier, compared to, it just made sense to us to come here. It wouldn't have worked.
Yeah, and
I completely hear you. Yep.
I think the analogy I use for that is don't let the loan forgiveness tail wag the debt repayment dog, right? So it's important to understand the whole picture and look at your, what all of your goals and objectives are, not simply just around the emotion of I've got so much debt and I need to get this debt taken care of, by someone else. So again, just I think what I take from that story, Joy, is to really make sure that you're understanding the big picture and operating in the context of an overall plan.
Exactly. I love that line. I should get a t-shirt that says that.
Just
All right.
Put a little Troy Zerveskes trademark on that.
I will. All right. And alternatively, we see folks that love their work in a federally qualified health center, right? Because that's where their heart is and that's where their mission calls them there. So I want to make sure to say that too at the same time. So you don't get emails later from people who are like, but wait. Yeah, okay. So let's look into some of the specifics here. So there are lots of repayment plans available to folks that have federal student loans. So we're separating this into two different sections. We're talking about federal loans, and then we'll talk about private loans or other refinance options for folks with federal loans too. So lots of income-driven repayment plans are available. Some of the tricks are that not all loan types are eligible for every different repayment plan. So sometimes we see folks that may be eligible for the revised pay-as-you-earn, for example, that's the newest repayment plan, but they're on an older plan, the income-based repayment, the IBR. Sometimes we see people doing this for no reason other than the fact that they started on the IBR. Maybe they finished school 4 or 5 years ago. At that time, the revised pay-as-you-earn wasn't available. And so they started on the IBR, and every year when they recertify their income, they've just stayed on the same repayment plan. And it might be that a newer plan would be better for them. So that's the most common mistake that we see. The second mistake we see is that it's more of a short-term mistake, and that is that people forget to recertify their income every year when they're on those income-driven repayment plans. So let's just back up and talk about in general. These plans are plans that are based on people's income and family size and a couple of other pieces in the formula from the loan servicing company. And every year the borrower will share with the loan servicing company their income from the prior year, and the loan servicing company will determine their monthly payment for the next 12 months. When a borrower is on these kind of plans, they're required every year prior to the anniversary of when they got onto the plan to document your income for the next year. So for example, let's say someone finishes their education and they're starting work in August, should we say. They might have a grace period until December. And so let's say they started their new repayment plan in December of this year. So next year, prior to that date in December, maybe it was December 5th, we'll just say, they need to have recertified their income, and the loan servicing company needs to have processed their application to recertify their income by December 5th. And if they fail to do that, or if the company is slow at processing, then that payment will bump up automatically to the standard 10-year payment amount. And if someone has $300,000 in student debt, then that payment is probably around $3,500. And maybe on their income-driven repayment plan, they're paying $1,000 or $600. So it could be a huge difference. And when folks are on automatic payments, which is very common and very helpful, if they don't catch it, sometimes that money is drawn out of their bank account, and it's quite the surprise to folks. In my practice, I'm always telling people about this, and often I'll get an email, usually only once from each client, but saying, oh gosh, I missed my deadline, what should I do next? So you can get that money back, often by stopping the payment from the bank. This is usually the fastest way to do it. Sometimes there's a real hassle factor to that. So we always recommend that people do that recertification 2 to 3 months before it's due. And we know the window to be able to do that opens up 100 days before the application is due. All right, any questions about income-driven repayment plans and common troubles there?
No, I don't think so. I think this is a fairly common, I think if we were to say, I feel like what I see, probably 70–80+% of people are in one of these types of plans. I don't know if that percentage is what you see, Joy, as well.
Yes, it really depends. It depends on the sector, but yes, they are very common. So we talked a little bit about this, the type of loans. For the revised pay-as-you-earn plan and a couple of others, they are only eligible for people that have direct loans. And sometimes people have loans that are a little earlier, and those would be the older FFEL loans, and those loans are not eligible for the newer repayment plans. So when a person has that situation, they can easily apply for a direct consolidation loan and consolidate those older FFEL loans into a direct consolidation loan, and then they would be direct loans, and then they would be eligible for the new repayment plans. Sometimes it's hard to know what loan type you have. The loan servicing company doesn't always make it easy to see on the statements, and so we send people to the National Student Loan Data Systems website, and they give a real clear printout of the loan types of loan and other data, but it's very clear to see there. If under the type of loan column you see the word direct in the line, then you know it is a direct loan. If that line doesn't have the word direct in it, it might say Stafford unsubsidized, for example, but it doesn't say direct in front of it, then it's not a direct loan. So that's the way that people would know the difference there. Sometimes we see people making the mistake of consolidating some loans that they don't need to. And so if you're listening to this, if you're in the audience or listening to our conversation tonight, if you have direct loans, some loans that are direct and some loans that are not direct, and you're thinking about consolidating, that might be a great option. However, if you've made payments already on your direct loans, you will not want to include those loans in the direct consolidation loan application. You want to keep them separate and just apply for a direct consolidation with the FFEL loans only. The reason for that is because it restarts the clock towards the 20 years or 25 years of payment that might be needed for the cancellation. All right, we're really in the weeds here, Troy. Are we okay?
We're doing well, thanks.
Okay, too many details, okay. So these are the different repayment plans. Let's talk about the revised pay-as-you-earn, since I'd asked you, Troy, to help me remember. So one of the greatest things about the revised pay-as-you-earn is the interest subsidy. Nate, are you familiar with this? Did your folks tell you about this as one of the good reasons to be pursuing for using revised pay-as-you-earn?
Nope. Could you explain it to me?
Yeah, I'd be glad to. So revised pay-as-you-earn is one of the repayment plans that has the lowest payment amount, which is great. The second thing that it has that is good is that every month the federal government will pay half of the accrued unpaid interest for you. Right, so would you mind, well, I don't ask you to share your information. Let's say that a dentist has $300,000 of student loans and they're on the revised pay-as-you-earn repayment plan. Maybe their monthly payment is $1,000. And we know already that their standard plan would be about $3,500. And so if they're early in their repayment, probably, most of the payment would be going towards interest, right? So actually most of the payment due, the $3,500, would be going towards interest at the beginning. And so let's say there's $3,000 of interest, $500 of principal, and the doctor pays $1,000 on their loan. That means that $2,000 is left of interest. The federal government will pay $1,000 of that interest. And so only $1,000 of the $2,000 is going to continue to accrue. So it's a really nice way for folks that are trying to take care of some other things in life right now, can minimize the amount of interest that's accruing on their student loans without refinancing.
Is that done on an annual basis, Joy, or is that done at the end, or when does that happen?
It's done on a monthly basis.
A monthly basis, huh?
Mm-hmm.
Is that something that can be seen on your statement? Like, so for instance, Nate, would you see that on your statement? How do they know that that's happening, Joy?
Yeah, you go to your account history. Sometimes it's hidden on the website. You got to really dig for it. And you can see, actually, it'll say on the statement that subsidy has been applied. There is one loan servicing company that reports to the federal government the amount paid every month, but they report it on a quarterly basis, and then they get the payment from the U.S. Department of Education on a quarterly basis, but then they apply it to each one of the month's payments. And I'm thinking that's Navient off the top of my head.
That's the one I have, actually. Navient.
Oh, good. So yeah, you could easily just, when you get a chance, check the statement. Have you been making payments for more than 4 months?
Yep.
Okay. Yeah, so check that statement, and they apply the October, January, whatever the other quarterly dates are. That's when you'll see on the statement when those dollars have been applied.
Cool.
Yeah. And if you want to send a copy of your statement over to Troy and he can share it with me, that would be terrific. I'd love to have one that I'll cross off your name, but I'd love to have one that I can share as a slide. It's a great question. Oh, look who's here. All right, great question. There are two things that sometimes makes revised pay-as-you-earn not the best option. Oh, who was that? Was that Ava?
Yeah, hi.
Hi, Ava. How are you?
Good. How are you guys?
Good.
Sorry for my late arrival.
We're just talking about student loans, right? You know, sorry, Joy, keep going.
Very exciting. So we were talking about the specific program, the revised pay-as-you-earn program. And so the student loan interest benefit is a very positive thing about that program. There are two things that are not as positive. One is that, different from Ava and Nate's situation, but for folks that are married to someone that doesn't have a student loan, sometimes those couples want to file their taxes separately and count just the borrower's income when determining the payment amount. On the revised pay-as-you-earn, they close that loophole and you're no longer able to do that. So for folks where of the couple only one has student loans, often it's better to look at the option of being on the income-based repayment or the pay-as-you-earn and file taxes separately. It's not always, doesn't always work out the best, but often it's something to consider. For married borrowers, absolutely fine to be on the revised pay-as-you-earn and use both borrowers' income. Comes out just fine. The third thing to think about with revised pay-as-you-earn is that there's no cap on the payment amount, on the monthly payment amount. On some of the other repayment plans, the standard payment amount acts as a cap on the monthly payment and can provide a nice overall benefit because it will cap the amount of payments even though incomes may go higher, and it reduces the amount you pay overall and you'd achieve more cancellation at the end. So it can be a great option for folks. And you can always change between repayment plans whenever you'd like. All right, let's keep rolling. All right, so this employment slide we can skip because it was about public service loan forgiveness. So here's a case study looking at Dr. Susan. So Dr. Susan came to us with $275,000 of student debt. She was just starting her new career. Her monthly payments under just the standard 10-year payment plan were going to be $3,130. I'm in the purple in the middle. Over 10 years, we estimated that she was going to pay $375,000 on her student loans. Now, why would she pay $100,000 more than she owed?
Interest?
Oh, thank you, Troy. Okay, very good. At the end of those 10 years, she'd be done paying. There'd be nothing left. There'd be no taxes due. And the only number that she was happy about on that first column was the last one, that she'd be done paying in 10 years, right? Because she wanted not to be paying on her own loans when her kids were having loans. All right. But that $3,100 a month was huge for her. And she was almost in tears, actually, because she wasn't certain how she's going to make that work. She's feeling behind, right? She'd been going to school for a long time, to drive in an old car, wanted to buy a house. You know how it is. There's a lot of other life happening. So instead, we looked at different repayment plans, and one of the ones that we looked at was the revised pay-as-you-earn. She had the same amount of student debt, but her monthly payments would be very different under that plan. So they'd start out at $350 a month, and over time, as her income increased, the payments would also increase. At the end of the 25 years for this plan, she'd be making payments of $2,600 a month. So much better in terms of the monthly payment amounts, much more breathing room for her. We estimate that she's going to pay over that 25 years $543,000 on her student loans. Plus, at the end of 25 years of payments, she's still going to owe $125,000. That's going to be canceled. Uncle Sam will count that as income in the year that it's canceled, and so that year she'll pay an additional tax of approximately $37,000. So for her, this was a plan that was good for the short term, but not a good plan for the long term in her specific situation. But these were the numbers, and it helped her to understand what that option was for her. What questions do we have, just about this scenario?
So, I brought up earlier that we were given the advice of doing this repay plan for 2-3 years or so, and then switching to a graduated standard repayment plan. I'm sure there's a million different strategies out there, but does that sound like like a similar situation to hers in terms of she was just going to do that in the short term and then switch over to standard later? Or, what does that sound like a good way to go about it? I guess, half the time we don't really know what we're doing.
I completely understand. Yeah. So Nate and Ava, I'm going to recommend that you set up an appointment with us after we're done, okay? And we will find out for you the perfect answer. But in general, absolutely, there are all kinds of combinations of plans that people do. The couple that I talked about earlier in the event, they ended up choosing to refinance and lock in lower rates now, right? Other folks do the revised pay-as-you-earn. Well, they're just sort of getting their feet under them and then plan to refinance later. There are folks that also, well, actually, rarely do folks end up, if they're going to pay the standard plan or the extended plan, rarely do they stay with the federal government's loan programs just because the interest rate is so high. It usually works out that it's better to refinance at a certain point. But like I said, every situation is different.
Is it difficult to find a way to refinance when you have the level of debt that we do? Like, I know there's like different refinancing options, but it seems like a lot of them are like up to a certain amount of debt, and it seems like we're surpassing all of them.
Great question. In fact, that'll take us to our next slide, Troy.
Oh, perfect.
Perfect. Way to go, Ava. So one of the other options beyond the income-driven repayment plans is a private refinance. And the basics are that you find a new lender, they pay off your existing loan, you get a new loan, and the reason to do that is to get a lower interest rate or a different term. And right now, rates, people have been worried that rates are going to be climbing, and so far what we've seen with student loan interest rates for refinance, they've gone up and down a little bit, but just this last month they went even down again. So we're seeing fixed rates at 3.25% and variable rates at 2.56%. Those are the rates that went down last month from 2.89. So very competitive rates. If you show the next slide, just shows what the numbers will look like. Oh, next slide 2, please. So if you owe $300,000 and your interest rate is 7.15% and you get a new interest rate that's fixed at 3.5 over 10 years, you'll lower your payments by $500 a month and save, over $50,000 overall. So that's the reason that people consider doing a refinance, is for a better financial picture overall and to lock in rates at this time. So back to your question. Go ahead.
No, that's exactly. I was gonna pivot back to Ava's question.
Yeah, thanks. I think the next slide actually has some examples or some people to use. Yeah. So, well, it is true, Anna, that there are sometimes limits to the amount that can be refinanced. The best place to go to shop for interest rates would be credible.com. Are you guys familiar with that?
No.
Nope.
Yeah, it's similar to Kayak or Travelocity when you're buying airplane tickets, right? You put your information in once and you get a lot of offers back. That's what Credible is for student loans. So many banks participate with them as a marketing tool. And so you put your information in once and you get a variety of offers. That's where you'll find out what the limits might be for the size of student loans that people have. I'm not often seeing folks running into trouble with that, but when we do, we just refinance the max, right? And then leave the rest, on the federal government program or the other lenders program. Yep, you can. You can pick and choose how much you want to refinance.
Yeah, I think I was just going to add a little commentary. I think that's one of the things about, 5 years ago, this whole refinance market didn't exist. And so it's in addition to these new programs, we also now have a myriad of new strategies where we can, depending on the portfolio, we can just take chunks of the loan, refinance them, and maybe even to take advantage of some of the lower interest rates, maybe we refinance that chunk at a shorter amortization to take advantage of that low rate while everything else is kind of still doing what it does, and kind of keep going through and doing some of those things. So I think that the point is that this whole refinance market has has added a whole new sort of toolbox of things that we can do that we couldn't do even 5 years ago.
That's cool. And now, so on this Credible website, is it something that they're looking at your personal credit when you're entering in this information to get like the quotes from people, I guess?
Yes, that's right.
Okay, so they do like a hard credit inquiry.
Oh no, that's a great question. Thanks for asking it. All of these would be pre-approvals, so they're all soft credit pulls.
Okay.
Back in the day, whenever we were applying to find out what the rate was, it was a full credit report, right? And then so that would ding your credit. And that's why Credible is so fabulous right now, because these are all soft credit pulls, and so they will not impact your credit score. When you pick one, like you're shopping for rates, you pick one, you'll do one application then, and that will have a small impact on your credit score. But that's for the one you're going to choose to refinance with. Go, I'm glad you said something. Good.
Thanks.
We're also seeing that doctors will get the best rates when they have 12 months of, like early career doctors, when they have at least 12 months of income history. So for folks that are perhaps earlier than you, it might make sense to refinance now and then refinance a year from now. You can always refinance again. You're not locked in. You don't have to stay with that rate, forever. And most doctors that I'm working with are checking rates every year. And if rates are lower, they're refinancing again. Absolutely.
Interesting.
Well, here's a question that comes to mind, and it's a little off topic, but I'm sure you've gotten it before as well. As I often hear, I'm only allowed to consolidate once. I didn't want to forget to ask you that question. Would you mind speaking to where that misconception or what they might be thinking about there?
Right. I hear that too, and I'm always wondering, where did they hear that? So I'm guessing that might be related to the direct consolidation loan. So if you have a federal loan that's a federal direct consolidation loan,
Sure. So, but I think
they're
that
not eligible then for another direct consolidation loan application, but you could always refinance those loans with a private bank.
yeah, I think that's something that I wanted to just make clear, because I hear that often, that you absolutely can refinance, especially in the secondary market, as much as you'd like to. And I think it's a big misconception out there that you can do it once and then you're done. That is not the case.
Thank you. Other questions about refinance?
No.
Okay. Let's see. Oh, I should say SoFi is the biggest player in the refinance area, and they do not participate in Credible. And so if you have excellent credit, SoFi is very particular in who they lend to. But if you have excellent credit, you might also want to do a pre-approval application with SoFi because their rates are usually pretty competitive.
Joy, is there selection criteria? Is it really just the rate, or does it vary much between one lender and another?
It varies pretty dramatically. I'm surprised, and it's not always the same one that has the best rates. So it really makes sense. We live by Credible because they do a great job of providing options.
So Joy, maybe if you wouldn't mind just spending a couple quick minutes, or maybe it doesn't take that long, maybe it's 30 seconds, of just telling what your process is. So if somebody comes to you and wants to understand their student loans in more detail and wants to know if they're on the right path, what types of questions are you going to ask them? What information do they have to have prepared?
Oh, thanks, Troy. Sure. We always start with a checkup. It's a free 15 minutes. Let me just see what you're doing, crunch your numbers to see if everything's good. And if so, there's no charge for the work we do together. However, many times there are things that have been missed or opportunities for savings. And so in that case, we would go forward with a full consultation. What we'd need for that, for our work together, would be your official list of student loans. And we'd send you a link so you can upload that into the appointment actually. And then we would need to know basic information about income and family size. And It's very simple. It usually doesn't take very long to put all that information together and get it over to us. The fee for our service is $395. It's a one-time fee. Currently, that's what our fee is. And it includes lifetime of questions for us for the lifetime of your loans. So we're happy to be a resource, Troy, to your folks and the New Hampshire Dental Society if needed. And the best way to schedule with us is to go to our website, www.navigatestudentloans.com. And at the far right, there's a tab that says schedule a meeting, and you just pull up our calendar there.
Great. So just to reiterate, so the first 15 minutes is of no charge. Kind of what happens from there is kind of based on what your portfolio looks like and sort of the intricacy of your planning, if you will. And then $395 is the fee going forward, and that will get them lifetime service to come back to you if they have questions.
Absolutely, yes.
Great.
Are these meetings something that needs to be done in person, or is that something that can be done in a similar setting to this, like just via phone call or something?
It'll be over the phone and computer.
Oh, okay, perfect.
What other questions? Anything else, Joy, that we haven't hit on that we should have hit on? Anything else that that people should know about student loans or your service or kind of the state? Actually, I've got a question for you. So, we all thought that 2017, October 2017 was going to be this huge banner year, that there were going to be, planes flying overhead with loan forgiveness happening. And it's been kind of crickets chirping. And sorry, I'll provide a little background. So October 2017 was 10 years of a loan forgiveness program. Now, only those dentists that would potentially be working at a nonprofit organization, something like that, would qualify for this, but I think it's pertinent for those individuals. So with Joy, we've kind of heard crickets chirping, and we haven't really heard much by way of forgiveness. What are you hearing, and what are you thinking on that topic?
Yeah, so the first borrowers have received their forgiveness. We understand that there was a total of less than 200 people that were potentially qualified to apply for forgiveness. Our business started in 2009, so none of our clients are there yet. But I do have colleagues that know that have 6 clients that are doctors that have actually received forgiveness. So we know that it's working, but it is, like you said, very, very small number of people that were aware of the program back in the day.
And I know that's, one of the concerns that, even in these programs that do have that forgiveness provision, I think a lot of my clients, as I can be sometimes, is well, if you ask my wife, not just sometimes, is that we have a healthy dose of skepticism. And, what's your thought about loan forgiveness in any of these programs, and can we count on it? Is it real?
Mm-hmm.
Absolutely. And I don't know if you remember, Troy, I'm a former registered lobbyist and I'm a big public policy wonk, so I'm not going to go too deep here, but there is a current bill going through Congress to eliminate public service loan forgiveness for future borrowers. So anyone that is currently has a student loan, is currently paying on a student loan, will not be impacted by that law if it passes as it is. We're working really hard to pass an amendment to preserve public service loan forgiveness. But the good news for current borrowers is that they'll be grandmothered in. And what that tells me is that there probably wasn't a way legally that they could get rid of that program for current borrowers.
Interesting.
Mm-hmm.
That's been, a topic near and dear to our hearts for many years. And so it'll be interesting to see how that plays out for sure.
Will be. The Prosper Act is, if you want to Google it. And also
the Prosper Act. Is that what you said? Okay.
That it is, yep. And also, just last week, there was a great news article in the New York Times about one of the first people that got loan forgiveness with public service loan forgiveness. It's a very interesting read.
Wonderful. We'll look that up. Well, great, Joy. This was a lot of help, and we hit on a lot of pretty important information that's near and dear to lots of people's hearts and many of my clients' hearts. And so I really appreciate your time tonight. Nate, Nave, anything that we didn't touch on? Anything else from your end that you'd like us to chat about?
No, I mean, I caught the tail end, but it seems great, and I can't wait to follow up. Nate took some pretty intense notes here, so I'm going to read over those.
I have one
Great.
question.
And for those, sorry, Nate.
No, I was just going to say, so, we're coming up on our first year, and one of the questions that came up amongst us was, should we make any amendments to our contract? And one of the things that got brought up was, how do you go about asking, or are they even able to, get your employer to cover student loans as part of a benefit in your contract? Is that something they can do? Is there a way to make that work before we're taxed on the income, I guess?
Boy, that's a great question. I'll say this, employers have the ability to do pretty much whatever they want. I'll also say that with as many dentists as I work with, I don't know any who have built in a student loan payment provision or support program into their practice.
Okay.
And to answer your question about taxability, I don't know of a way that it is considered pre-tax. It's always, even if they would pay directly to your lender or they give you the dollars as a student loan incentive or a retention bonus, it's always taxed.
But I think you're bringing up a great point, Nate, and I think a lot of employers, and maybe that'll be part of my talking points as well, as a way to incentivize and retain, because that is obviously near and dear to a lot of the associates' hearts, and it's scary because as these numbers get bigger and bigger, oftentimes an associate's income kind of is what it is. And that's one of the scarier parts of you kind of are oftentimes forced to move on because you need to get those incomes higher to compensate for the debt and those increasing payments. So that wouldn't be a bad strategy for a dentist owner to be giving some thought to, for sure. So it's a great point, and I probably will talk about that at some level, at least try it on for size with some owners.
Yeah,
I
It's
think
a great point.
we heard it from one of our friends. I think he was in Vermont.
I can't remember.
It was a friend who was getting an associateship somewhere. It might have been in a clinic, but it was built into his contract, or he requested that it be built into his contract. And we're like, we've never heard of that before. Probably worth asking about.
Yeah, I mean, I think in a lot of it, and I think Nate, you hit on this earlier, it was a patient, but I think a lot of the owners don't realize what dental educations cost and what student loans. When I say that Tufts is $100,000 a year now, to a dentist that's been around for 15, 20 years, they look at me like I have three heads. I'm not sure they fully understand the problem. So part of it is an education element too.
Mm-hmm.
So this will go out in the e-news. So hopefully this will go out in the Dental Society e-news. So hopefully, even some of the later stage career dentists will choose to give this a listen. So, all right, guys, this was a fun night. Joy will have all of your information on here, but it looks like navigatestudentloans.com is where people can go to contact you if they'd like. Certainly people can follow up with me directly at advisoryresourcegroup.com is my website. And this was fun. And actually, I did want to say this is a great accompaniment to the other session that we did on Financial Literacy 101. We sort of just touched on student loans at 30,000 feet. So I'd suggest to anybody that hasn't watched that to go back and take a look at that as well, because I think the two of these go together really, really well. All right, guys, thanks so much. Have a great evening.
Thanks, you too. Bye-bye.
Thanks, Joy.
Thank you for joining us for this episode of the New Hampshire Dental Society webinar series. Please contact today's presenters for additional questions or details on the information provided. Advisory Resource Group offers to meet with New Hampshire Dental Society members with no cost or obligation. Please contact my office directly or visit advisoryresourcegroup.com to schedule an appointment.